Why is it that rich people often seem to thrive when the economy slows down? When things are flying high, opportunities are plentiful, but everyone is competing, prices are high, and risk is visible. In a slowing economy, fear spreads like wildfire. Uncertainty freezes ordinary people into inaction, and that's exactly why the wealthy can act with confidence. While most people tighten their belts, cut back on spending, and stress over bills, investors with resources quietly seize opportunities others never even notice. Before we get into it, make sure to hit the like button and subscribe if you haven't already. It really helps out the channel and it will make sure you get to see more videos like this. Now think about your neighbors or coworkers. When the economy is humming along, homeowners feel secure. They're not thinking about selling unless they want to. Businesses are expanding and employees feel safe hopping jobs or asking for raises. Investors might wait for just the right deal, but the pressure to act is low. Now slow the economy down a little. Suddenly, that same homeowner worries about what happens if their overtime disappears or a bonus gets canceled. A small business owner who was comfortable last year lies awake thinking about payroll if revenue dips another 10%. And a company that had grand expansion plans quietly freezes everything and starts planning layoffs. This isn't failure, this is ordinary people reacting to stress. And here's the secret. Pressure creates choices. Choices create opportunities. Wealthy investors love downturns because the pressure that forces other people to act out of fear isn't on them. They have liquidity, multiple income streams, and systems in place that allow them to make calculated moves while everyone else panics. For example, when the housing market dropped in 2008, many ordinary families scrambled to sell or were forced into foreclosure. Meanwhile, investors who had cash in hand bought houses at 50% below pre-crash values. In 2020, when the pandemic caused massive layoffs, millionaire wealth continued growing because those with investments could buy discounted stocks and ride the rebound, while millions of workers were just trying to survive week to week. Oil stocks plunged to a tiny fraction of their previous values. Why? Fear and panic had taken over the market. Did anyone actually believe these major companies were about to disappear? Of course not. If that happened, the consequences for everyday life would have been catastrophic, since oil plays a critical role in producing and transporting food, fuel, and other household essentials. Yet, while many were selling out of fear, investors who stayed calm and thought logically saw an enormous opportunity to buy at bargain prices. And this is not an isolated case. There are countless similar examples across many industries whenever fear dominates the market. The reason this works is straightforward when you break it down. During economic slowdowns, fear tends to spread faster than facts. People rush to sell homes, stocks, or small businesses, hoping to get out before prices bottom out. This drives prices sharply lower, creating a temporary window of opportunity. Imagine an online store suddenly putting your favorite item on a 30% off flash sale for a limited time. The item is suddenly much cheaper, but the deal won't last long. Someone with cash can grab the best bargain right away, while others hesitate. Selling your own items out of fear that they might offer another 10% off for a short period is missing the opportunity. You lose potential gains instead of waiting to act smartly. Next is access to capital. Having money tied up in investments, homes, or luxury items that can lose 30% or more overnight is very different from having cash or readily available credit at your disposal. When problems hit, like a sudden job loss or urgent business need, people without accessible funds often have no choice but to sell assets at steep losses just to cover immediate costs. This is why access to capital is such a powerful advantage for wealthy investors. They purposely maintain cash reserves, lines of credit, or other liquid resources so they can move quickly when opportunities arise. For example, during the 2020 downturn, businesses and stocks were plummeting, but investors with ready cash could swoop in and acquire high-quality assets at steep discounts. Even a modest safety net like a 6-month emergency fund or a pre-approved credit line combined with other safety measures allows someone to act decisively while everyone else scrambles, sells in a panic, or misses the chance entirely. It's this combination of preparation and immediate financial flexibility that turns downturns into opportunities, while those without access to capital are trapped, forced into choices that lock in losses instead of building real wealth. Income resilience is another crucial factor. Most people rely on a single paycheck, which means that if their employer reduces hours, freezes raises, or lays off staff, their entire financial stability can wobble instantly. Wealthy investors, on the other hand, deliberately create multiple sources of income: rental properties, dividends from stocks, side businesses, or partial ownership in different ventures. This diversification means that if one revenue stream slows down during an economic downturn, the others continue to provide cash flow, giving them the breathing room to make thoughtful choices rather than reacting out of fear. Even relatively small sources of income, like a freelance project, a part-time online business, or selling digital products, can act as a buffer that prevents forced asset sales and keeps long-term investments intact. The result is when prices drop and others are scrambling to cover their expenses, these investors can calmly deploy capital to acquire undervalued assets, turning a moment of widespread panic into a strategic advantage. Essentially, multiple income streams reduces pressure and gives flexibility, both financially and emotionally. Wealthy investors have also cultivated the knowledge and experience to recognize opportunities long before most people even notice them. They keep an eye on asset values, trends, and financial fundamentals, so when prices drop, they can quickly evaluate both the potential risk and the upside. This is very different from someone blindly speculating on a hyped-up stock or trendy investment that crashes. Suddenly, these seasoned investors can identify genuinely undervalued businesses, rental properties, or even collectibles that are temporarily priced below their true worth, while fear keeps others on the sidelines. Imagine a crowded garage sale where novice buyers overlook a vintage bicycle because of a little surface rust. An experienced buyer, however, sees beyond the cosmetic flaws, understands the long-term value, and recognizes an opportunity most others completely miss. In real markets, this ability to separate temporary panic from true weakness allows informed investors to acquire high-quality assets at bargain prices, positioning themselves for strong gains when confidence and prices recover. Finally, patience, the paradox of wealth accumulation. In a slowing economy, most people want to sell immediately to prevent perceived losses. They panic, lock in their losses, and miss the eventual rebound. Wealthy investors, on the other hand, can hold through volatility because their foundation is stable. They understand cycles, periods of expansion, contraction, stabilization, and recovery. History shows that markets recover stronger than before. Warren Buffett didn't panic during 2008. He doubled down when others were terrified, and the result was billions gained over time. Patience isn't passive, it's strategic. It turns temporary fear into a long-term advantage. For wealthy individuals, their income almost always exceeds their expenses by a comfortable margin, and that difference is what gives them an edge during economic downturns. Take someone making $80,000 a year, but only needing $40,000 to cover everything from rent and groceries to utilities and insurance. If they suddenly lose one income source, say a $40,000 per year salary, they're not immediately in danger because they still have other income streams coming in, like a side business, rental payments from a property they own, dividends from investments, or royalties from a small project. That extra breathing room means they can carefully evaluate opportunities, buy assets that are temporarily undervalued, or even invest in projects that could multiply in value later. Having income comfortably above expenses turns situations that feel like financial disasters for most people into strategic opportunities for those who are prepared. Consider two individuals with similar incomes but very different financial habits. One relies almost entirely on a single paycheck and is invested heavily in high-risk assets during a strong market. When the downturn hits, their investments drop sharply, work hours are cut, and they're forced to sell at a loss. The other person has a built-in robust safety net, a substantial cash reserve, diversified investments, and at least one additional source of income. When the same downturn occurs, they may also face job disruptions, but they aren't forced to liquidate investments. Instead, they can gradually acquire discounted assets, allowing their portfolio to recover strongly over time. There are many reasons the rich love downturns, and they almost always come out financially stronger while the unprepared struggle. Downturns don't create inequality, they reveal it, showing who has the habits and preparation to survive. Anyone can shift categories by holding cash, diversifying income, investing thoughtfully, learning financial basics, and practicing patience. You don't need to be wealthy to start, just disciplined and prepared. Every slowdown is temporary, but the opportunities it creates are real. Prepare, stay strategic, and when fear grips everyone else, you'll be in a position to act and even thrive. Prepare now because another downturn is always on the way.